All right, so with that out of the way, I'm going to leave my mic on so I am able to speak to you guys the entire time. I am going to put down the Discord text chat and I am purely going to focus on the presentation. If there are any issues with the stream at any point in time, just go ahead and at me on the classroom floor. It will notify me, it'll flash, so this way I can stop and I can proceed to go to the classroom. Please do not do that with questions. We will wait and we will field questions at the end of the presentation and class. So with that out of the way, thank you very much, everybody, for coming here tonight. My name is Joseph, and tonight we are going to be doing a class on equity trading as a whole, and we're going to cover particularly stock creation and trading. Okay, this is intended to be a investing 101, a foundation for you guys who are newer traders and looking to start your career as a professional trader, or if you are looking to purely learn a little bit more and you're looking to possibly take your investments to the next level. So, with that out of the way, let's start out with a disclaimer. I like to do this for every single presentation that I do with you guys. It's important that we do this. So, statements by United Traders, UT, or its members are opinions and not investment advice. UT is not responsible for any investment decisions made using the information provided. Improvements are not guaranteed. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies that are mentioned here on United Traders. So, with that out of the way, guys, let's get down to business. The equity market, okay, the equity market, also known as the stock market, which we call it, right? Normal people, is where shares of stock are traded between buyers and sellers. This is done on the trade floor of a stock exchange and through computers, like we do, by using brokers like TD Ameritrade, E-Trade, Fidelity, Robinhood, and many, many others. There are two common misconceptions that right off the bat I want to address with everybody is that the S&P 500, the Dow Jones Composite Index, and Russell 2000, they're all indexes. They're not stock exchanges. And indexes are measurements of value of a given section of the market. The two major US exchanges actually are the NYSE, the New York Stock Exchange, and the NASDAQ. Okay? Both public and private corporations issue shares of stock, not purely just public corporations. Shares of stock are created at incorporation, which is done for each of those individual companies, and they are intended to create ownership in that company. Most transactions in stock exchanges, however, will indeed involve publicly traded companies. So the next logical question from there is to ask, why do stocks exist in the first place? All right, so companies can obtain capital in several ways, and some of these can include reinvesting their profits back into the company. They can take out loans, or they can issue what we call shares of stock. Stocks allow a company to raise capital by trading ownership of the company in exchange for money. Your percent ownership can be calculated by dividing the amount of shares that you own by the total amount of outstanding shares. So, for example, if you had 10 shares, and there was 100 shares outstanding, if you were to divide 10 into 100, you would have zero point 0.1 or a 10% ownership stake in that particular company. Now, shareholders vote on all fundamental corporate changes in the company, and that would consist of things like mergers, acquisitions, or the sale of the company. They receive profit sharing in the form of quarterly dividends if the company chooses to give dividends, and these are roughly based on the performance of the company in that quarter. The company ultimately decides how much they want to give and whether or not if they do at all. So the next logical question from that point is, how are shares of stock created? Okay, so when a company makes the decision that they want to incorporate, they file what we call an article of incorporation with their state government, specifically the Secretary of State of that particular state they're wishing to incorporate in, and they establish several things in that document. They go over the company name, their address for their headquarters, the company's purpose, their directors' information, their names, their addresses, and how many shares of stock that they're going to issue upon incorporation and what we call the par value per share. Okay, a company is required to set that minimum share price, that par value. The company is not allowed to sell the stock at a price lower than the par value that is set. However, they are free to sell it at any price above that par value. So, par value was established during the Great Depression, but it plays a diminished role in today's markets. Some companies list no par value as to avoid potential liability to shareholders altogether. A majority of the time, you will see 1 cent down as being a par value. Sometimes you will even get fractions of a cent listed as being the par value. But again, the general idea is that individuals will either list the value or they will list no par value, again, to avoid potential liability with shareholders if there ever was a situation in which the stock was trading below that particular value. The corporation is limited to the amount of the shares that they have agreed upon in their articles of incorporation unless the shareholders vote to amend their articles of incorporation in order to issue more shares. So, for example, if a company wishes to go public, they may want to issue more shares to increase the amount of potential investors upon them publicly trading. Or, if you are IGC and you're looking to scam people and get more money, then damn it, a $15 million increase for your shares is a great way to go about doing it. All right, so how does a privately held company go public is a great next question that you guys didn't ask, but I asked, so let's go into it. An initial public offering, or an IPO for short, is when a privately held company makes the decision to be publicly traded. So, for example, let's say the shareholders of ABC Incorporated make the decision that they want to go public. So, they amend their articles of incorporation to create more shares. They then file the appropriate paperwork with the SEC, the Securities and Exchange Commission, which is an independent government agency that oversees the market. ABC Incorporated will decide upon the price of the stock for which it will be sold once public, and the stock exchanges will then sell the shares at that particular price. Now, that can change. As we saw earlier today, we had a stock that was looking to have, I believe, a $33 share price at the start, but the first actual trading for that was in the 60s. So, although you may end up setting a particular share price that you're hoping to be, or a particular range that you would like to be in, that may not actually end up being the price that it first starts when it does hit the market. With that out of the way, though, let's get into hopefully what a lot of you guys were here to be able to learn is to how can I go about my trading career? How can I start trading? First, responsible trading is ensuring that you are in a safe financial situation before you start trading. First rule, do not trade money that you cannot afford to lose. This includes money that you would normally use for rent, foods, bills, any responsibilities that you may have. Next point, get a job. Seriously, if you don't already have consistent income, do not make this your full time job if you are inexperienced. That income that you will get on a regular basis will be imperative to your success. Do not trade money that you have saved for emergency situations or medical costs. This is dangerous and it is highly frowned upon. The market can be very stressful, and that stress is only amplified when the money that you have invested in it is the difference between you paying your bills or putting food on the table, or God forbid, you happen to have an emergency situation and you've tapped into your funds that otherwise would be there in the case that you have uninsured costs that need to be covered. It ultimately is a horrible situation to put yourself in. So please don't put yourself in that situation. And I want you guys to ask, everyone here, to ask yourself the following question again, not in the chat, but here to yourself personally. If I were to lose my investment, would I be able to maintain my responsibilities? And if you answered yes, then the money that you are trading with is okay to trade. Now, this can include money in your savings account or perhaps an IRA. These are great example of funds that are usually okay to trade. Perhaps maybe in general, that you have money that was extra in your checking account that you don't have in a savings account. That also qualifies as well, so long as, again, the money that you are using is not otherwise reserved for handling your responsibilities day to day. Second rule, before you deposit any money into any brokerage account, take the time to learn as much as you can about the market. Unless you have a solid foundation and an understanding of the following 9 topics, don't even think about starting to trade real funds. So out of the nine, we're going to go one to nine. So number one, they're not ranked by importance. They're purely just item points that we're going to go over. Number one, learn the basics, right? What is the market price? What is the ask and the bid? How do they relate to one another? What are stock splits, reverse splits, all of the basic things that go into trading on a day in and day out basis, right? Number two, learn how to read stock charts. What are candles? What do the colors mean? And what does the shape of each candle say about the price movement? Number three, learn about due diligence. Never ever make a decision because someone told you to do so. I don't care if I enter a position and I'm on the voice chat and I let you guys know of that position. I don't care if TJ is in a position, no matter how good he is, or Johnny, no matter how good he is. If anybody tells you about a particular position, do not blindly follow that individual. That is the one thing that we always try to guide you guys against. Do your own personal research on the company that you're interested in, or if there is a suggestion in the chat, take the time to make sure that it fits your personal trading style, that you're comfortable with taking the trade, and that most importantly, you are able to take the trade. Do that research on the companies that you're interested in. Make sure that it's a decision you're comfortable with before you jump into it. I cannot stress that enough. Number four, learn about trading volume and its relation to price movement. If you're not studying volume price analysis, then you are one step, if not two steps behind everybody else in terms of price action. Please take the time, head over to our new traders program. We have a great book, free book that's put out by Anna Cooling that goes over volume price analysis. It is a must read. We also have videos from SMB Capital that goes over looking at order flow. Those guys are absolutely imperative to your success. You need to know what is going on in front of you, not only just by purely reading your candlesticks, but understanding your order flow that's coming in, that evolution of that minute candle that you're watching, and having a great understanding of what that means for the future of that price action so you can make that educated decision. Number five, learn about stock indicators. So, what is RSI, MACD, and moving averages? Get to know them well and how to implement them into your analysis. Major firms use them in their analysis, so there's no reason you shouldn't be as well because the less information that you have at your disposal, especially when at the end of the day, we're really just trying to get on the coattails of smart money, the less we know about their personal analysis and the less that we have at our disposal to also make an educated decision, the worse off we're going to be. Number six, learn what stock screeners are. This will be a great tool to help you find companies that fit exactly what you're looking for, whether it fits by sector or by specific performance metrics. These are great programs and websites that you will have at your availability fingertips that helps you get into the right trades at the right time. It's the reason why we did the Trade Ideas GoFundMe. It's the reason why we have that stream for you guys every single day. That is a great example of a gold standard stock screener. And it is, again, what I personally use. It's what TJ personally uses. It's what a lot of major traders will use in their day to day in order to be able to find stocks that fit the particular, again, performance metrics that say, look at me, I'm ready to be primed for a position here, possibly. Number seven, I want you guys to find a comfortable routine. Look at the different trading platforms that are out there, right? Find a user interface that speaks with you. Find a charting program or website that you like, and then come up with a system from research to execution that works for you. And whatever it is, make sure that you're comfortable when you trade. I can't also stress that one enough, right? Everyone has a preference. I know that TJ also enjoys Thinkorswim just like I do, right? It is an unparalleled platform in terms of your capabilities, your technical analysis. It is a one out, right? It's all on its own. It's a class within itself. But you got to find something that fits you and what you're comfortable with, whether or not if that's going to be a trade station, whether or not if that's going to be a trading view, whether or not if it's FinViz for your scanner, whatever works for you that you're able to make work. The general idea is that that is what you want to stick with. try and incorporate some new things perhaps to see if it works or if you can make some needed adjustments that would help you. But the general idea, again, is to be comfortable, and that's going to help you go a long, long way. And when we talk about coming up with a system, it means saying, hey, I wake up in the morning and I have my cup of coffee. I start up my computer. I load up trade ideas. I load up the Discord chat. I wait a little bit. I'm trying to see what the gappers are like. I have my morning routine that I like to follow. I'll then open up Thinkorswim. I'll log onto the platform. I'll start bringing up some charts and I'll do some charting. I'll look at particular areas that the gappers are at. I'll look at their daily charts, yada yada yada, the whole spiel, all the way from the time that you wake up in the morning until the time that you are executing your trade. So that includes doing your research as well, like I was starting to get into, and that could be purely from a charting standpoint and technical analysis, and it could also be from a standpoint of doing fundamental analysis and looking at a company's financial situation to see whether or not if it fits what you're hoping it to be. And then again, all the way up until the execution of your trade, the managing of your trade, and the exiting of your trade, you want to come up with a system because at the end of the day, this entire game is about having what we call an edge. That edge is going to be the difference between you being profitable and not being profitable. That edge, if we want to say from a joking standpoint, right, the house always has an edge. And that edge is what allows them over a long extended period of time to be able to make consistent profits despite the fact that they're handing out large amounts of money to other individuals who win. That edge is anything that allows you to preferably be right more than 50% of the time. As long as you're right more than 50% of the time in what you're hoping to achieve, proper management of your positions will allow you to be able, over that long run of time, to have consistent profits. Anything under 40, I'd start to be a little worried. But again, as long as you are over that 50% mark, again, you're looking at what we're calling an edge. And as long as you are properly handling your trades, it'll allow you over an extended period of time to be successful. Number 8, I want you guys to paper trade first before you even get into real life trading. I cannot stress this enough. If there's one thing that I want you guys to take home, is that do not go into this blind without actually doing some paper trading first. Okay, this is an unforgiving environment, and practice will make perfect. Take the time to paper trade until you have that solid strategy and you are consistently profitable. And as much as I would love to say that that will be the end all be all and it's going to be an indicator for you to be successful, it is just one small part because number 9 is quite possibly one of the most important things that a lot of people tend to neglect. Is taking the time to learn about trading psychology. The emotions that go into trading real money over paper trading is completely different. That moment that you finally have your money on the line and you click that button and your order gets filled, regardless of what direction you think it's going, it will take you for a spin, even if you were a consistently profitable paper trader. There is nothing that compares to the rush, the endorphins. There's a reason why trading in the stock market is considered to be just as addictive sometimes as gambling, and perhaps maybe even at times as addictive as drugs for some people. So do not ignore this. You won't truly understand the feelings that you have in live trading until you've actually got your money on the line. So take the time, learn about trading psychology. I know that the admins have a great foundation in it. I know that Stock Authority is a little bit of a master and a guru when it comes to trading psychology. Again, look into it. Do not neglect it. It will be the difference between you leaving a trade early and leaving profits on the table to holding on to a losing trade longer than you should and taking more of a loss than you had originally intended. Okay. So now the third point that I wanted to go over is you need to figure out the exact amount that you're going to invest and you need to stick to that. Do not give up or minimize the account after a few bad trades. You want to treat your investment as though you won't see it back in your account for at least a year. Most brokers have eliminated deposit minimums, and some are even lowering or eliminating fees altogether, and this allows your investment to be more profitable. The reason why you should, and when you do start your actual trading, is to not give up, is because when you first start trading and you're going through those issues of that trading psychology, you make a couple of bad decisions, it is very easy to get down on yourself. And it is very easy to try and say that it's time for you to just pack it up and to go home. But so long as you are able to maintain, again, a consistent strategy, you stick to your rules, and you are consistent, machine like, cold blooded, you are trading as though you are like an algorithm, but you make sure that you make those emotions a part of your day-to-day trading, that you're able to allow your position to evolve over time, and you're not purely just hitting your profit target and then saying, "That's it, on to the next one." You make sure you hit your profit target. Maybe you scale down in your position, and then you look for how, again, reevaluating and looking at the evolving of your position and saying, hey, you know, I'm either going to close my position entirely or I'm going to reevaluate and set a new profit target for X. That is very important to do. It comes with time. So when you have your first couple of bad trades, do not panic, do not wrap up shop, keep going at it. Again, treat those investments as though you won't see it for a year. So finally, one of the last points before we get into a breakdown of your possible portfolio is that, again, finding a brokerage firm is very important, whether if it's from a user interface side or whether or not if the broker fits the particular objectives that you have in your investment journey. So finding one that works for you and your investment strategy is important. So a couple of different options are, for example, if you have a small account and you are ensuring that you want to hold on to as much capital as possible for the purpose of investments, Robinhood is a great platform for you guys to have. I know that Webull is another coming up on the scene. So another one. This is a great option for people with smaller accounts, and you're looking to maintain and hold on to as much capital as you possibly can. If you're looking to get into options, again, if you're looking for no fees, Robinhood is available. But I cannot recommend Tastyworks enough for a very, very good platform that is aesthetically pleasing. It gives you a lot of information. It is a great platform for individuals who are doing option trading. They do have $1 contract fees with no closing fees. So it's purely when you open up the contract, not when you close it. If you're looking for no PDT, and you're looking to again have an account that's under $25,000 without being restricted in terms of your pattern day trading rule, perhaps you look at SureTrader or perhaps maybe even TradeNet might be right for you. So, and I know constantly over and over again we've gone over in the chat about what TradeNet is. I'll be glad to maybe do another lesson on it. I won't go over it right now, but again, SureTrader or TradeNet are two great options to avoid PDT rules and accounts that are under $25,000. And then finally, like I said before, one of the best platforms I think out there is TD Ameritrade's Thinkorswim. They have extremely powerful software. I think that it is second to none. And it is my personal recommendation for anybody who is looking for not only a charting software, but also looking for screening that is free and looking for great fundamental analysis with access to several very important analysis by big firms that their entire job is to be able to look at a company and break it down, not only through their fundamentals, but through their market and where they're strong and where they're weak. Again, TD Ameritrade gives that to you all at your fingertips. I cannot stress that enough. It is my favorite platform, and I know it's one of TJ's favorite platforms as well. All right, so what are some suggestions for the ways to split up your portfolio? Okay, one of the best things that you can do for yourself is to have proper management of your investments. And through an understanding of your personal risk tolerance, you're going to better serve yourself now and into the future. Generally, the single rule of thumb is the younger you are, the more aggressive you should be in your investments. So, for example, first question being, are you younger with steady employment? If that's the case, then you want to look at more aggressive investments because you will have the time to make up any particular losses that you might have. The general rule of thumb, and I will skip over the second point that I have here, is a general strategy for you guys to have is what I always refer in the chat as the 80-10-10 rule. 80% of your investments should be focused on being in what we call long term investments. We're going to cover this in the next slide. 10% will be in short term investments, and another 10% can be preferably in a security or at least a equity alternative. And for me, I like it currency alternatives. So I try to avoid anything that's directly tied in with currency. So maybe perhaps we're looking at gold or silver, cryptocurrency. I would also possibly include as a currency alternative, even though it is obviously within itself. It could, it is digital currency, but I'm referring to currency from the standpoint of forex, not in terms of the currency of it relating to, again, cryptocurrency. So 80-10-10 is a great way to go about your portfolio to ensure that you're limiting your risk and that you're making sure that you are getting consistent gains over time while limiting those aggressive investments. Now, again, if you are younger with steady employment, perhaps you can take that 80% of that long term investment and bump it down to 60. I would say possibly no more than that. I would say that that is going to be pushing it, but never ever go into this with the intention of taking your entire account and purely pumping it all into intraday or swing trading. That is a recipe for disaster, especially if you are a new trader. I would really suggest that you look into proper long term investments, having that smaller portion being short term so you can ensure, again, that you're getting consistent gains as you're not only working on your craft, becoming better each and every day, but again, you're making sure that you're locking in consistent gains as you continue to get better. And then you can possibly think about increasing your short term position to have more aggressive growth. And the second point that I had left out, which is if you are older and you're looking towards retirement, then you want to place most of your investment in less volatile securities and focus on smaller, consistent growth. Just as always, a rule of thumb, when I look at those long term investments, I'm really looking for the following, at least in my point, is what are business sectors that you think are integral to the economy, right? These are areas that see consistent growth year after year, or they move with domestic or international conditions. You want to narrow these particular sectors down to about 4 to 8 and start looking at companies within those sectors. Another way you can go about doing this is to look around you. What are some of the products, services, or brands that you think the world cannot live without? These are examples of staples of the economy, and they're usually great investments. Once you've done this, you should select a company and look at the stock's performance in comparison to the overall market and its direct competitors. And for me, I like to look at that particular stock. I like to look at its comparison whether or not if it's going to be more consistent with the S&P 500, if it's in the Dow Jones, if it's in the Russell, wherever it normally would be considered. I want to see it actually perform better than the major market indice, and I want to be able to make sure that it is performing better than its direct competitors, or at least in line with its direct competitors, and maybe perhaps they have an edge or an advantage that is not currently reflected within the stock's performance over preferably at least a year. You want to look and see how the last year has gone for that particular stock. Okay. Look at their fundamentals in previous earning reports, right? ERs. Are they positioned for continued growth or improvement? Okay, it's one thing if they happen to have great fundamentals, but if the last ER shows really weak guidance going into the next quarter, then you might want to take a step back and you might want to, again, revamp that particular position and see whether or not if it is indeed right for you. So, again, look at the fundamentals. We're here to help you with the beginning journeys of learning about company fundamentals and their financials, right? And we're here to help you for when you are dealing with earnings reports as well. So, again, we will have lessons in the future to really go over in depth on this, but don't ever be afraid to come in on the chat and ask a question regarding these things. We're more than happy to answer it if we have the available time. But again, your major point is you want to look at these things to see, do they have competent management? Are they able to really continue their operations, right, without running into any issues? Let's say for whatever reason, income was to stop coming in. Can they continue for, let's say, a 12-month period, right? Is their absolute, bottom line profitable? So what are what's their revenue coming in? What are their expenses going out? And is that operational cash flow positive, right? There's a bunch of different things to look into. But the general idea is you want to make sure that the fundamentals point to a competently and effectively run company by that board, and that their ER show consistent growth better than their competitors, and that at the end of the day, that they are setting themselves up with great guidance. And I know that that's kind of like a hotly contended item, at least within the investment community, with some of the big talking heads, that perhaps maybe guidance should be taken a step back in terms of that reporting. But I still personally believe that guidance is an effective measure for you to be able to decide whether or not if it is indeed a company that you want to be able to invest in. Because again, you want to make sure that they're going to have continued growth and improvement. Now, once you've done all of that, I know it's a lot, guys, but you want to establish what a fair price target is. And I guarantee you, right? You'll be able to find examples even if you yourself don't come up with that fair price target, right? Go to those major reports that we talked about that you can get off of Thinkorswim, off your major finance companies, your major companies that do their research on the individual stocks, right? Find out what their price target is for this. Get a better understanding on what their time frame is for that price target. After you establish what your fair price target is that you would like to see the stock to go to, because again, we believe that they're positioned for continued growth and improvement, you get that price target. Now, you need to understand and figure out what you're willing to risk on that particular security, and then you want to ensure that you're purchasing the security on a discount. Once you're in the position, leave it alone. This is not a day trade or a swing. Reevaluate only once you either hit your risk that you have established for it or your price target. I always suggest that you guys should always be reevaluating your positions. Don't ever set it and forget it to the point where we say, okay, well, ABC stock is currently $10, and I think it has a price target of $90. So I'm just going to risk $1, and whatever happens, happens. If it goes down to $9, I'm screwed. If it goes up to $90, then yay, I've made a whole bunch of money. Don't ever make that your prerogative. What you want to do is you want to say, okay, here's ABC stock. I'm willing to risk $1 on it, but my price target's going to be $12. That's my first price target. If it reaches that, at that point in time, you say, okay, let's reevaluate. You're always reevaluating your position because it evolves over time. You're looking at those fundamentals. You're making sure they're still competent. You're making sure that the board is still handling the company properly, and that is indeed reflected in those financials. Next, again, always the ERs. How are they performing quarter over quarter? What's their guidance looking forward? Now, there may be times where it's not exactly what you're hoping it to be, but at the end of the day, again, as long as you are constantly looking at your position, you're reevaluating it as you get to those particular areas that you set, you will be leading yourself up for success. So now let's go over, and this will be our final slide, guys, is short-term investments. And these, again, should be your 10%, right? And that is your day trading positions, your swing trading positions. So day trading, right? These are positions that we hold as investors for seconds, minutes, or at the longest, a few hours. This is the most volatile and addictive form of trading. We've also got swing trading that we see a lot going on in the chat room. These are positions that we hold for hours or at the longest a few days. In both cases, we're risking a certain amount of money. So, for example, 1 to 3% of, let's say, your entire short term investment. Again, 10% of 100% of your portfolio. So, in other words, if we're going to make it really even more confusing for you, 1% of 10% of 100% of your portfolio with the intent to make twice that amount. So, that's going to be a 2 to 1 reward risk ratio. So, if I'm putting up 10 cents on the line, that means my goal should at least be 20 cents. Now, of course, that doesn't always mean that it works out that way. I'm watching the position and it will evolve over time. Perhaps maybe buyers don't step in when I think it's going to happen. And I end up saying, you know what? Let's cut it while I'm at a good profit here. And then promptly 5 minutes later, it bumps up 50 cents. And I'm probably swearing in the chat room because I missed out on my position. So, that's kind of what happens. You got to make sure that you're following it. I know we all do that all the time, right? You're not going to be immune to that. So again, it's always an evolving position, but make sure that you're at least going in with the mentality of that 2 to 1 reward risk ratio, and you're setting yourself up for success. I really want to make sure that I mention this as well. If you are dealing with day trading or swing trading, I forget the quote from from Warren Buffett, but it's somewhere around the lines of margin is basically the death of most traders. Okay, I would ask that if you do indeed have a broker that allows you to be able to use margin trading, I would really suggest that you use it with caution, and I would really suggest that you ultimately be very, very careful in your investments. And there are a couple of major points to take home. Day trading, a lot of individuals, myself included, will use leverage because it allows us to be able to buy large amounts of shares while still maintaining that particular risk amount that we have. I might take out, $160,000 position. I may buy 1,000 shares of a stock that is, $160, right? But that's not what I'm risking. I'm still risking, let's say, $100. So I'm risking 10 cents on this position, right? What's going to happen is that margin can help you if you don't have an account of that size to be able to take out that particular position. Let's say if your account was $20,000, right? Or in this case, let's say you are in a broker that doesn't allow you. So let's say you're at least $25,000. You're at least $25,000. Some brokers will give you different leverages amounts. Sometimes it's four. Like if you are with brokers like Thinkorswim, if you are, for example, with like Colmex, I believe some traders can get up to 20 times leverage. The general idea is that that's going to give you more buying power to take your positions, but always be smart with the amount of money that you're risking and always be aware of that amount that you are indeed risking. And make sure that you're at least maintaining that 2-to-1 reward risk ratio. But here's the major part about margin that you always need to be aware of. I know I'm the lawyer guy in the chat room, right? But always read your contracts. Never ever purely accept the terms of service with your broker and just blindly start trading. Okay. For example, if you have a margin position and you hold it overnight, your broker, depending on the contract that you signed with them, may be able to charge you interest for holding on to that money overnight or by the day. Depending if you're a swing trader, you hold on to it for a week and you're using margin, you're going to end up having to pay fees. You're going to end up having to pay possible interest on the amount that you're investing. And most importantly, one of the most dangerous things is I see a lot of people going heavy into positions, most of that being margin, and they're not setting up the appropriate stop losses. The last thing you want to do, guys, especially if you are not in a position to do it, especially if you're holding things overnight, I can't stress this enough. Use your cash. Do not use margin to hold overnight, purely from a standpoint of, let's say you hold on to ABC overnight. It's mostly margin. And what happens if it plummets that night? Right? You'll lose 90%. You have a dead cat bounce because you decided you wanted to get into a biofarm. You thought it was going to be great. And what happens? It drops 90% on bad news that's released at 6 p.m. or something. You wake up in the morning and unfortunately you didn't have anything set up and it's down 90%. You're going to be on the hook not only for all the money that you lost, that's all gone, but you're going to be on the hook for any of that money that you lost that was directly tied into that margin that you were borrowing. And not only are you going to owe that money back, you're going to owe interest on it for every possible day, if not, and most brokers should do it by day. But what's going to happen is that you're going to be on the hook for interest for each and every day, month, etc. Whatever your contract says with your broker, you're going to be on the hook for interest on that money. So again, be very careful if you are using margin trading. Again, only use it if you are doing intraday trading. You're opening the position in the market day, you're closing the position the same day. Do not hold margin overnight. I really, really, really suggest against that unless, again, you are a very, very experienced trader and you have favorable terms that allows you to be able to do so. But I honestly, I can't push that enough. Please don't do that. So again, short-term investments. The reason why it can be very dangerous is that we're looking for volume and thus volatility, right? These are either based on news catalyst or technical analysis. And this will point us into the direction of the security that we're looking to invest in. That's why we have the Trade Ideas scanner. It lets us know when we have things that are fitting technical analysis parameters that tell us that this is a good buy, or perhaps it's letting us know that there's a large amount of volume, or perhaps volatility is going nuts on it. Again, the general idea is that volatility means opportunity, and we are then looking to have confirmation through volume, investing, making our money. That's the gravy, right? That's the end goal at the end of the day, right? But again, when you're dealing with something like this, it's very volatile, it's very dangerous, so be prepared to possibly lose this money. When you're dealing with short-term investments, it's called an aggressive investment for a reason. However, with the proper mentality, training, and trading strategy, you too can begin to turn regular profits on short term investments. So I'm going to fall back one last time to the previous slide, 2 slides ago. I'm sorry. I'm going to really try and close down on the following. I can't stress this part enough. Most of our traders should be, if you are not currently doing so, you should be looking at having a majority of your total portfolio in long term investments for the pure purpose of ensuring these consistent gains over time without risking on aggressive investments. You promise me it'll, or I promise you that it will serve you over the course of your career. And as you are able, if you are younger or if you are able to do so within your career, to increase your amount of short term investments, to increase that risk as you continue to become a better investor, intraday or swing, start to look into increasing that portion of it. But I can guarantee you, investors like TJ, what they do is they set up very similar positions like 80-10-10. Right now, his 10% might be my 80 right percent. Right, we can joke about that. But what's going to happen is that investors like TJ are going to take his winnings from his short term, more aggressive investments, and he's then going to take that and bump it to his swings, and maybe he might take his swings and bump that to his long-term investments. But what he's always doing is that he's taking his aggressive investments and anything that's over what his allotted amount is for his short-term investment area, and he's bumping certain amounts or excess into other areas of trade, and that allows him to continue to expand his account size and make sure that a majority of his account is in less aggressive but still positive gaining position. So again, guys, 80-10-10. I cannot stress that enough. It is a great way to go about doing it. And I promise you that if you're able to take everything that we went over tonight, I know we covered a lot in a very short period of time, although it might feel like forever for some of you. I promise you, if we can get a good foundation with you, it will serve you in the future for your trading career. So, again, guys, I want to thank you very much for stopping by here tonight. I know I haven't really had an opportunity to do a lesson for a while. I know I pop into Frank's masterclass every now and then, but please, it is greatly appreciated. Keep working on the craft. Keep coming into the chat every day. You guys are the reason why we do it every single day. You guys are the heartbeat of this group, and we do this again for you guys. So thank you for those who participated today. It is again my pleasure to be here. So I hope you guys have a great night. What we're going to do now is I will field questions. This will be the end of the stream, and we will now move over to Discord. So at this point in time, close out the YouTube live stream, make your way over to the Discord chat, and make sure that you unmute your mic if you normally have it unmuted, and make sure that you undeafen the chat as well so you can hear anyone who may be talking over voice. So again, guys, this is Joseph from United Traders. Have a great night, and thank you so much for stopping.